welcome to the Money Puzzle. Question of the day, what is $525,000? We'll get to that in just a second. First of all, I'm Brian Ramsey. This is Chris Vaughn. We are Family Wealth Planning Partners located right here in Louisville, Kentucky. Offices at the corner of Hurstbourne Lane and Shelbyville Road. So let's answer the question, Chris. What is $525,000?
$525,000. It's a really big number. Let's start with that. But it's the amount of taxes that the average person will pay in a lifetime.
It's staggering, isn't it?
Yeah, it is. It really is. And that's the biggest problem with that is if you were going to purchase something that cost $525,000, right? You'd put some thought into it. I mean, that's like a house, right? Nice house here in Louisville. Right. You don't just willy-nilly go out and do that. And you know, you and I have talked about this. When you're going on vacation, where you're going to spend $2,000, $3,000, $4,000, $5,000, you put weeks, maybe even months of planning into that. $525,000 in taxes, most people don't do any planning for that. They just show up and hand a bunch of paperwork to an accountant and say, you know, get me a tax return.
Yeah, absolutely. And the interesting thing is when we were doing the research for the show, when we Googled it, I had never thought about it. Yeah. And we were like, well, how much does the average, how much tax a person pays? And when we talk about $525,000, it's your income tax, it's taxes you pay when you go out and you buy groceries, it's property tax, it's auto tax. They're looking at all of it together, but still, it's a huge number. And it's funny when folks come in and we talk about taxes, we ask them, hey, you know, what kind of tax planning do you do? And we hear, well, you know, I go to my CPA or my tax preparer, and that's pretty much all the real tax planning that they do. Or
you just hear crickets when you ask that question.
Or most times you hear crickets, yeah. That's correct, yeah. But what's interesting is we're like, okay, let's do this. We know what the national average pays. Let's see if we can find out what the average Kentuckian pays, right? And so here's the numbers we got. So on earnings, the average Kentuckian is going to pay $225,000. And that's earnings tax. So that's all your state, federal, state, and local. Expenses, they said expensive, but it's like, you know, buying groceries and T-shirts and pants when you go out. $61,000. Property tax, $70,000. That surprised me a little bit, but that's the number they had. And then car tax, auto tax, things like that is another $25,000. Yeah. Now, the interesting thing about this is, when we look at the tax, I then Googled how many people pay no tax, no federal income tax. 40% of Americans do not pay federal income tax.
Wow.
So, okay, now you look at it in perspective and say, well, if 40% pay zero, then on average, the other 60% have to have a pretty big number in order to make that number, you know, 225,000 for Kentuckians, that have a number.
Right.
So think about that. That's a big, giant number. So really, if you're working and you have a decent paying job, you're probably paying a lot more than $225,000.
Right, because the 225 is assuming that's an average, right?
That's exactly right. All right, so let's talk about taxes in perspective of the money puzzle. So maybe we'll spend a quick second, talk about the money puzzle, how we came up with it, what the four corners are, and where taxes fit in.
Well, when we talk about the money puzzle, we're talking about the way that you put together all of the different parts of your financial life. So, you know, you and I were talking about it earlier today. It's like you take that jigsaw puzzle, and when you open up the box, you dump everything out on the table, right? And then you start working. Well, what do you look for first? That's the four corners. So the four corners would be income. That's a huge one right there. That's your permanent predictable income, your non-permanent non-predictable income. But one of those corners is taxes, because during your retirement years, taxes are going to be the single biggest expense that you have. Most people think it's health care, something along those lines, but it's taxes. So as you're putting together that money puzzle, taxes are one of the most important things you have to look at. And what else did you want to go into on that? I'm sorry.
No, just explaining the money puzzle, right? Yeah. You're just explaining the four corners and where taxes play in that.
So, I mean, that really is, taxes are a corner piece, if you will.
Yeah. So let's talk about when someone becomes a client and we talk taxes. We talk taxes in the very beginning, right? Yep. So in the process of us onboarding a client, we talk about taxes and we have that discussion. How do we view taxes on an ongoing basis? What's our approach?
After we have onboarded a client, if you will, then we set up a series of meetings to kind of build out the perimeter of that puzzle and then fill in the rest of it. And we do that typically with 3 meetings every single year. And one of those meetings is dedicated to taxes. So instead of just showing up on April 14th and handing your accountant a bunch of paperwork and saying, get me the biggest return you can, tax planning has to take place in advance. So we're doing this typically in the fall of each year. What are the things that can be done while we still have time this year that are going to set you up correctly for your taxes, not only this year, but also looking at the longer term approach? So just to kind of give you an idea of some of the things that you can do. You can talk about Roth conversions, which has been a hot topic here recently because we know taxes are going to go up in, the end of 2025. Unless Congress does something, which doesn't appear that there's an appetite for that, we know taxes are going to go up. So if we can eat some of those taxes now by converting, say, IRA money into Roth IRA money, you pay the taxes on it now, then you won't have to pay taxes on that growth in the future. So theoretically, you're paying that at a lower rate. That's one of the little tools that you can do in your tax planning. One of the big ones that people run into is RMDs. That's required minimum distribution. So depending on the year you were born, those are going to hit in your early 70s, and you're going to be required to take money out of your qualified accounts, 401ks, IRAs, things of that nature. You're going to have to take a certain amount of money out each year. You're going to have to report it as income and pay the taxes on that. Well, it might not be a convenient time for you to do that. And, we've got clients we've worked with that RMD is 6 figures, even though they didn't necessarily need that. So you have to put that planning in. So should we be taking money out a little bit earlier than our 70s, even though we don't necessarily need it now? Take it out, convert it into something different like a Roth or maybe a straight brokerage account. Then how are you charitable? So most people here in Kentucky are still charitable to something. Well, when you get into your retirement years, especially in your 70s, you need to be charitable in a different way. There is a strategy to go about doing it where you can be just as charitable as you planned on, or more so, but you're disinheriting the IRS. You're not paying that money out in taxes. So you're being charitable, you're saving money on yourself, and you're not paying those taxes. So that's part of tax planning.
Yeah, and I would tell you that taxes are a component or an edge or a corner piece of our puzzle. It's so important that we dedicate a meeting every single year to have that conversation around taxes. Not only how do we, what are some strategies we can put in place this year to minimize our tax impact, but also what happens if we do something today? How would that impact us years down the road? And so, Chris, why don't you tell folks when they come in, that is a piece of the puzzle, right? But what would somebody experience when they come in to meet with us for the first time?
So the first time that somebody meets with us, we set up a simple appointment. You're going to come in, and we're just going to get to know each other. Is this going to be a good relationship? Are we actually going to be able to help you in the ways that you need? So that's the first step. The second thing that we're going to do is we're going to determine a probability. So if you continue doing things the way that you're doing them right now, what is the likelihood that you'll be successful? Whatever successful means to you, that's unique to you. And then the third thing that we're going to do is we're going to create an actual written report that you can take home with you, no strings attached. We're not going to sell you anything. You're going to have that takeaway to know, here's what the framework of my puzzle is going to look like.
Yeah, great. All right, so if you're watching, schedule an appointment, and we'll be right on the other side. We're going to talk about where do you get your tax advice. We will talk about that on the other side. Be right back. All right, welcome to Friday at the Firm. As always, that's Chris, I'm Brian, that's Eric, and that's Aaron. This week I got Penelope.
I really like this one. It's a little bit hard to find. We started out as, 4 guys in 4 different places with their own individual practices, and we realized that if we banded together, we could do things more efficiently, give the client a much better experience, and that's how Family Wealth Planning Partners began.
Outside of work, we love being with our families. We love spending time with our families.
We are all family people. How would we want our families treated? That's the way that we want to treat our clients, and that's the way we want to interact with them. it's not a handshake relationship. It's very much a hug relationship.
The most enjoyable part of our client meetings is the first 15, 20 minutes when we're just talking about family. We share our lives with our clients, and our clients share their lives with us. So our clients come to us for lifestyle preservation. That's what we provide them. How do I maintain my current lifestyle throughout retirement?
Well, we're absolutely a planning-centric firm. So everything that we do is rooted around building a comprehensive financial plan for our clients.
Our clients are people who are nearing retirement or in retirement. They've done a really good job saving over the course of their career working. They may have a 401k, they may have an annuity, a life insurance policy or something. So they've done a really good job doing things, but they don't know how to make all of those individual things work together. That's where we come in. We call this the money puzzle.
Our job is to make sure that we put together those puzzle pieces for you so you have a clear, comprehensive plan of what your retirement is going to look like.
The reason why we do what we do is when clients come to us with a messy puzzle, they sit down with us and say, I've got all my pieces that are everywhere. I want to retire. Help me put my puzzle together.
When you bring all those pieces together, that's how you get it into alignment. That's how you bring in that picture into focus.
It's like a light bulb goes off in our clients' eyes, and you can see it. You can visibly see them look at this and say, okay, I get it now. I know how all the pieces of the puzzle come together to complete my financial picture.
We're trying to provide a relationship with our clients that they know that no matter what comes up, no matter what life throws at them, they can come to us and we can provide the answers and the recommendations to navigate those waters.
All right, welcome back to the Money Puzzle. I am Brian Ramsey along with Chris Vaughn. We are part of Family Wealth Planning Partners located right here in Louisville, Kentucky. And before the break, we were talking about taxes, and we're still talking about taxes. Yep. And what we talked about at the end was talking about where you get tax advice. That's critically important. And what we find is when somebody comes in or we're talking about taxes and we say, well, hey, where do you go to get tax advice? A lot of times they don't have an answer, or they'll say, well, I go to my tax preparer. Okay, well, what kind of conversations do you have? The overwhelming majority of the time, people are saying, well, I just dropped my taxes off. I got a big stack of 1099s or whatever, and I give it to them. And there's really not a whole lot of dialogue other than, hey, I'm missing this 1099, and they get their taxes prepared, and then they come back and they pick up their tax return, sign the documents, and move on. That's not tax advice.
Right.
Right? It's not tax advice. So maybe explain how we approach tax advice with clients.
Well, it goes back to what we were talking about a minute ago. This is the single biggest expense you're going to have during your retirement years. So the advice is, okay, what is the most efficient, what is the optimal way to go about paying your taxes? Because you're going to pay them. You cannot get away from them. The IRS is exceptionally good at getting what they think belongs to them. So the advice comes into, all right, when we start taking money out of our accounts in order to pay ourselves, okay, our retirement years, what's the sequencing look like? When should we take that out? So for example, what a lot of people will do is they'll say, I'm going to take Social Security at this age in order to pay for this item. And then I'm going to start taking money out of my 401k at that age to start paying for these items. It's a very inefficient way of doing it, primarily because of the taxes. People don't realize that Social Security is a true double tax. You paid taxes on it to get it there, you're going to pay taxes on it when you bring it out, but it's taxed in a different way. It's calculated differently. So if we maybe move the time that we're going to file Social Security and take money out of an IRA, for example, that changes the tax implications on it. So that's where the advice comes in. What is the lowest possible amount of tax that I can pay over a lifetime? That's your starting point. So that's where we get into the sequencing of where money comes from during our retirement years. And that's where the advice comes in.
Yeah, and so we all need to be careful where we get advice as well.
Right.
And the reason I say that is because we had a caller that called in, I'm going to say 6 weeks ago probably. And she'd come in and part of our discussion was around taxes. And she said, well, funny you ask, I had a significant tax bill that I am in the process of paying now. Well, okay, explain that. She had inherited money from a friend, and the institution where the money was, they asked her to open up an account at that same institution, which is very common practice.
Sure.
So it should have been a trustee, what they call a trustee-trustee transfer, which is basically moving it from one entity to another entity, and that's a non-taxable event. The issue was that during this process, the institution where the money was miscoded the 1099 and coded it as a distribution, not a transfer.
And that's a distribution from a qualified account.
Correct, which was a taxable event.
Yep.
And so they came to us. We wound up getting on the phone with that institution and her tax preparer and said, what's going on? What's the story? Well, we found out was the tax preparer, let's just say, was not a trained CPA, was not a trained enrolled agent, nor did they spend their career doing tax returns. They are doing this as, I'd say, a passion career after full retirement, and they work for a major name that you would know. Mm-hmm. So really, are they that qualified? Well, I don't know. They kind of took a test, and they're doing tax returns. She was telling us information that we knew was incorrect. In fact, we got that prospect in front of a CPA that we work very closely with, and even that CPA was telling her exactly what we said. The interesting thing about it was she decided to continue to do business with that current person that did her taxes. Here's the impact of that. One, she paid $130,000 in taxes when she didn't have to. And secondly, the money that was now in this account that she was going to take out of over the course of her the remaining part of her life will be taxed again because it's going to be coded as a distribution. So you have to be very, very careful of where you get your advice and who you seek your advice from. So again, we can't stress enough that when it comes to taxes, you have to seek the advice of a professional. Do we give tax advice? No, we work with tax professionals and our clients to seek proper tax advice. That's kind of that's the most important thing, is you've got to get in front of people that are experts in their field in order to get proper advice around those particular topics.
Yep.
Right? All right, so Chris, let's talk about the experience when somebody comes in, okay?
All right.
So somebody comes into our office, they're going to make a call here shortly. We're going to open up the phone lines here in a few minutes. They're going to call 844-900-5210, and they're going to schedule a call. They're going to schedule a meeting with us. They come in. What's going to be their experience when they come in?
Well, like I said, and you just said it, first of all, you call the number or you scan the QR code at the bottom of your page. All you're going to do is schedule an appointment. When you come in for that appointment, what we're going to do is we're going to get to know you. We're going to go over your situation. We're going to, answer the questions that you have, make sure that this is going to be a comfortable situation for you. Then we're going to take the pieces of the puzzle that you've got and figure out the way that you're doing it right now, probability of success, whatever you define that as. And then the next thing that we're going to do is we're going to give you a written plan that shows you what your money puzzle is going to look like. We're not going to sell you anything. It's a very relaxed environment, no pressure whatsoever. And that's what that first meeting is going to look like.
Okay, very good. So if you are worried about taxes, which everybody is, make sure you give Chris a call at 844-900-5210 and schedule a meeting, and we will be right back, and we're going to talk about our taxes going to go up. Who knows, but we'll find out in just a minute.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter, the one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
All right, welcome back to the Money Puzzle. I'm Brian Ramsey. That is Chris Vaughn right there. We've been talking taxes, and the question we get a lot is, are taxes going up? Actually, we did a show not too long ago about the most Googled topics, financial topics, and that was like number 4. Are taxes going to go up? I'm going to guess that taxes are probably going to go up. And when do we anticipate taxes going up? Soon, right?
Well, under normal circumstances, you can say, well, I have no idea what the government is going to do in the future. But in this particular case, unless they make a change, we know exactly what's going to happen. Because the tax cuts that we got back in 2017, those are going to sunset at the end of 2025. So taxes will be going up in 2026 from where they are right now. We know that unless they make a change to it. So, you know, some of the things that are going to happen that people don't think about. The standard deduction that we used to get was basically doubled. Well, now that's going to go back. That's a huge deal for a lot of people because you're not going to be able to take that big deduction. And therefore, you're going to have to pay a lot more in taxes. One of the big ones was, and we were talking about this the other day, corporate tax rate is going to go from 21% to 35%. Now, that's a huge jump. And you say, well, I'm not a corporation, so how does that matter? Well, that flows through. If you think about it, because of inflation over the last couple of years, everything that we buy is considerably more expensive than what it was, right? From your groceries to your vacations to your cars. Well, if the corporate tax rate goes up that much, they're not just going to go, oh, well, we got to pay more. They have margins that they have to hit. They have payrolls they have to hit. They have shareholders that they have to keep happy. So what happens is when their taxes go up, that means they're going to raise the price on everything that they make and sell. Well, that will end up in the end consumer. So the cost of what you buy is going to be going up because of the taxes that are on the company that you're buying it from. So this particular time around, we know our taxes are going up, and they are going up big time.
Yeah, and that's not to say that we've only increased our debt, national debt, from, we looked it up, 2017, the national debt was at 19.9 trillion. I said that right, trillion?
I think that, okay, trillion.
Yeah, I don't know how many zeros that is, but I know it's a lot. And at the end of this past year was 31.3 trillion. So if you think taxes are not going up, you're living in a
Neverland.
Neverland.
Yeah.
Taxes are going up. They have to increase revenues in order to pay off this debt. Not even to pay off the debt, just to pay the interest on the debt. I'm not, that's paying off the debt is a whole different story.
That's never going to happen.
Yeah. So here's the question. The big question is, and I'm sure if you're watching right now, the question is, what can we do? What should we be doing? What are some of the things that we should be thinking about when it comes around taxes?
Well, okay, first of all, go back to what we've been talking about. You need to plan for them. You need to think this out well in advance. That's the reason why with all of our clients, we have a dedicated meeting every single year to kind of plan out, here's what we need to be doing, here's the changes we need to be making, here's the movements that we need to be doing to help mitigate that tax burden. We want to make it as low as we possibly can within the law. So that's kind of the first step. The second thing that you need to do, or maybe the first thing, would be get professional help. Make sure that the person or persons that you're getting that advice from are actually qualified to be giving you that kind of advice. The story we were talking about before the break, where the lady had, it was $750,000 or something like that, that they moved incorrectly, and she didn't want to take the advice of multiple people who know what they were doing. She stuck with somebody because she knew them that was not qualified. Get the emotion out of this. Be logical, get good professional help. And that's the biggest first step to it.
Yeah, and I will tell you that I'll give you an example of kind of one of the more impressive meetings we had with a client at CPA. So this client was introduced to us, and we said, okay, throughout the onboarding process, we said, one of the things we need to do is we need to sit down with your tax preparer. He said, well, I do that every year anyway. Okay, well, let's sit down again, and let's walk through a couple of scenarios. So he was a business owner, and we sat down and met with his entire team. So we brought the entire team together, and we just walked through his scenario, what he was concerned about. Well, come to find out, there was a couple of things that he was worried about selling some property, and we wound up talking to him about how we could move some assets around and use it revocable trust and irrevocable trust. It was kind of a complicated situation, but the answer is we had his entire team there, including his CPA, and by us doing that planning, we saved him $150,000 in taxes for this coming year, so 2023. But had we not done that, he wouldn't be saving $120,000. And so that's why it's so critically important to sit down with your tax preparer and have that meeting every year, because had we not done that, he would have paid more taxes than he should have. And this guy didn't want to pay any more tax, just like I'm sure all you are watching right now. You don't want to pay any more taxes than you have to. You shouldn't have to, but you have to plan. You have to make sure that you understand what you can do, what strategies are available that can help you mitigate taxes the best you can. All right, Chris, let's talk about, you talked about Roth conversions.
Yep.
Okay. Let's talk about Roth conversions and also talk about the benefits of contributing to a Roth in your 401k. Again, ways that you can save money.
Absolutely. Well,
save on taxes.
First of all, people have to understand what the difference is between a traditional and a Roth. When you're dealing with a traditional, be it a 401k or an IRA, you're putting money into that pre-tax, right? Then it grows, whatever type of investments you've got, tax deferred. So you've never paid taxes on this money at all. Then when you take it out, you have to report that as income. And your income tax is the highest possible type of tax as opposed to capital gains and some other things. On a Roth, you're putting money in that you've already paid taxes on. It then grows tax deferred, just like the first type, but when the money comes out, you don't have to pay income taxes on that as long as you follow the rules, which are easy. So that growth never gets taxed. And that's the real beauty of the Roth. So a Roth conversion is where you take money from that first type, that traditional, and you move it into the Roth, right? That's a taxable event, so you don't just move the whole amount. That's where we bring in the CPA and we calculate the right amount to do each year. That's good tax planning. And once you get it into that Roth, now you never have to pay taxes on that money again. So you're paying taxes at the optimal time. That's the way a Roth conversion works.
Yeah. So taxes are an issue, right? I mean, most people look at it and say, yes, it's an important piece of my retirement or my financial life, but I don't do a whole lot of planning. If that's you, Chris, tell them what they could, what we can do to help them.
Well, first of all, you need to call 844-900-5210. Schedule a time to come in and meet with us, and we'll get to know you and we'll talk about those tax concerns that you have. Why is it that this particular thing is really bothering you? We'll go into all that. We'll figure out the best way to solve that problem for you, and you will leave us with a written report that shows exactly how to put your money puzzle together.
Yeah, that's great. So again, if you're watching right now and you want to give Chris a call, 844-900-5210, and Chris can help you put your money puzzle together, which includes taxes, and we'll help you mitigate taxes the best we possibly can. Make sure you tune in next week. Take care.